Welcome to The Explainer. Today we're diving straight into the newly released second quarter economic numbers for 2026, and honestly, we have a bit of a mystery on our hands. At first glance, the headline economic growth looks, frankly, super disappointing. It looks like the engine is sputtering out. But when we actually pop the hood and analyze the real data points driving these numbers, we find a roaring engine that's just being masked by some very specific statistical drags. So we're going to decode exactly what's happening in the U.S. economy right now, and more importantly, what it means for the rest of the year. So here's the headline that had absolutely everyone talking. Second quarter GDP came in at just 1.5%. We were at 2.1% in the first quarter, and the Reuters consensus forecast expected us to hold steady right there. Instead, we got a glaring miss. Now, the smartest guys in the room were actually already seeing this coming. Goldman Sachs downgraded their forecast to 1.8% right before the release, and JP Morgan went even lower to 1.5%, which ended up matching the Atlanta Fed's GDP Now model perfectly. But, a drop is a drop, right? Well, not exactly. Okay, let's dive into this because this is where the story gets really interesting. If economic growth is slamming on the brakes on paper, why does it feel completely different on the ground? Why are malls packed, restaurants full, and businesses still writing these massive checks? To understand this disconnect, we have to look at how GDP is actually calculated and figure out what's artificially dragging that top-line number down. To crack this case, economists look at a metric called final sales to domestic purchasers. Now, I know, it sounds like a total mouthful, but what this essentially does is strip out all the volatile impacts of international trade and business inventories. You see, the trade deficit subtracted nearly a full percentage point from GDP growth for the third consecutive quarter. Plus, businesses just didn't stockpile goods in their warehouses as much as everyone expected. When you remove that trade and inventory drag, you reveal a much healthier, vibrant reality where everyday consumers and businesses are actually spending heavily.
Section 1. The consumer spending engine, revving up the economy.
So consumer spending is the absolute bedrock of the U.S. economy. We're talking more than 2/3 of all economic activity. And in the second quarter, after grinding to a near halt in Q1, the consumer totally woke up and accelerated sharply to an estimated 3.8% annualized pace. What exactly injected all this fuel into the consumer engine? It really boils down to three main catalysts. Step 1, a massive $140 billion boost from recent tax refunds injected straight into household incomes. Step 2, higher income households riding the wave of really strong asset price growth. And Step 3, massive one-time events like the FIFA World Cup and the spending frenzy around the midterm elections acted as major triggers. People had cash and they eagerly spent it. But as we look at this massive spending spree, we kind of have to tap the brakes on the optimism just a bit and ask, how long can this actually last? These catalysts, tax refunds, a World Cup, these are temporary sugar highs. They aren't structural, permanent shifts in everyday income. And when we check the dashboard of the American consumer, there are definitely some bright warning lights flashing right now. Because this number right here is the flashing red light, 3%. The household saving rate has literally plummeted to just 3%, which is nearing a 4-year low. This is absolutely crucial because it means the cushion everyday Americans have for emergencies is draining, and it's draining fast. At the exact same time, pain at the pump has returned. Gasoline prices have climbed back above $4 a gallon. We're looking at an incredibly fragile situation where consumers are keeping the economy afloat, but their wallets are running on fumes. Which brings us to Section 2, AI's trillion-dollar boost, the silent powerhouse. And this brilliantly illustrates what's happening on the corporate side. If there's one word defining this entire economic expansion, it's AI. Global AI spending is fast approaching $1 trillion in 2026. $1 trillion. To put that into perspective, that's roughly 1% of total global economic activity. This historic boom in capital spending on information technology rose 18% year-on-year in Q1 and directly added 1.4 percentage points to GDP. It's actually masking weakness elsewhere. For example, business investment in physical structures has contracted for 10 straight quarters. But the AI wave is so massive, it's completely hiding those deep cracks in the foundation. I mean, to really grasp the magnitude of this, just look at the jaw-dropping moves happening right now by tech giants. Meta is partnering with BlackRock on a $14 billion AI data center in Texas. OpenAI is in talks to lease a staggering $500 billion AI data center campus in Ohio. Yes, $500 billion for one campus. Anthropic just announced a $5 billion investment from AMD. The four largest U.S. hyperscalers are projected to drop about $695 billion in capital expenditures this year alone, rising to $870 billion in 2027. And AI-related bond issuance, it reached $270 billion by early July, almost double all of 2025. These tech giants are single-handedly carrying the economic torch. Moving on to Section 3, the trade and inflation drag, and the headwinds building on the horizon. We mentioned earlier that trade subtracted from GDP for a second straight quarter, which is what kept that top-line 1.5% number so low. Let's break down exactly why that's happening. In June, the goods trade deficit actually narrowed slightly to $101.5 billion. Normally, a narrowing deficit is good news, right? But here's the paradox. It was still worse than the $100 billion economists expected, and it improved for entirely the wrong reasons. The gap didn't close because America sold more goods to the world. Exports actually fell by 1.8% to $204.7 billion. The deficit only narrowed because imports fell even faster, dropping 2.6% to $306.2 billion. So the crucial point is how this connects right back to our silent powerhouse. We have what you could call the AI trade paradox. All of those massive data centers and servers we just talked about, building them relies incredibly heavily on foreign imports. Capital goods imports surged a massive 37.4% year-on-year. Because the AI build-out requires bringing in so much technology and hardware from overseas, this heavy trade headwind isn't going away anytime soon. It's totally baked into the technology boom. Shifting gears to inflation, we actually see some seemingly fantastic news. The Consumer Price Index, or CPI, dropped significantly from 4.2% in May down to 3.5% in June, handily beating the 3.8% expectation. Core CPI also ticked down to 2.6%. But we have to ask, what caused this sudden drop? Well, energy prices fell 5.7% month over month, with gas prices dropping nearly 10%. This was heavily linked to a fragile ceasefire in the Persian Gulf that eased oil market volatility. But as we noted a minute ago, gas is already climbing back above $4, meaning this inflation relief might be incredibly short-lived. So you take this complex picture of booming domestic demand, mix it with volatile inflation, and it puts the Federal Reserve in a very tough spot. Led by Chair Kevin Warsh, who's really facing his first major test here, the Fed just voted to hold interest rates steady for the fifth consecutive time, keeping the benchmark at 3.5% to 3.75%. Warsh pledged an unwavering commitment to bringing inflation down, but he offered very few clues on the future. And actually, the decision behind closed doors wasn't unanimous at all. 3 dissenters actively pushed for a 25 basis point hike. Markets are now pricing in a 60% chance of a rate hike by September. The Fed is clearly divided, which just reflects how incredibly tricky this economy is to steer right now. Section 4. The road ahead, navigating the risks. Now, what's really interesting about this slide is the deep mathematical paradox we're seeing in the labor market. To understand where we go from here, we have to look at the American worker. Employers only added 57,000 jobs in June, which is a huge slowdown. Yet the unemployment rate actually dropped to 4.2%, its lowest since June 2025. How on earth is that possible? Well, it's because the labor force participation rate plunged 0.3 points, down to 61.5%, hitting its lowest level since March 2021. The unemployment rate hit a multi-year low not because of a massive hiring spree, but simply because people stopped looking for work and left the workforce entirely. As we look toward the rest of the year, we're definitely staring down some massive geopolitical and economic potholes. First, the US-led war with Iran is in its 6th month. Any escalation there poses a direct risk to oil prices, which directly drives inflation. Second, our consumer tailwinds are fading. The tax refunds are spent, the World Cup is over, and wages are barely keeping up with inflation. Third, ongoing trade tensions and tariffs continue to weigh heavily on the manufacturing sector. Taking all of this in, Goldman Sachs projects modest full-year growth of 2.6%, but they strongly note that the risks are heavily tilted to the downside. So let's bring it all together and look at the Q2 economic report card to summarize this incredible paradox. We have a headline GDP of just 1.5%. We have inflation cooling on paper to 3.5%, though largely due to fragile temporary oil drops. And we have unemployment dropping to 4.2%, but only because workers are leaving the labor force. We essentially have a sluggish headline number that is completely masking an underlying economy that is still being fiercely driven by spending.
And that brings us to the ultimate takeaway here. The U.S. economy is showing some very real, tangible resilience. Consumers are still spending, and tech giants are pouring nearly $1 trillion into artificial intelligence infrastructure. But at the exact same time, the headwinds are building up fast. Trade is dragging us down, geopolitical risks threaten inflation, and we have a divided Federal Reserve trying to navigate the whole shebang. The first half of the year kind of gave us an optical illusion. The second half of 2026 is going to be the real test of whether this foundation holds.
Which leaves us with this final provocative thought to chew on as we watch the data roll in over the coming months. With household savings draining down to a mere 3%, temporary consumer boosts totally fading, and global conflict simmering over the oil markets, is the sheer brute force of this trillion-dollar AI engine actually enough to power us through the rest of 2026? It's the multi-trillion-dollar question, and honestly, it's going to be absolutely fascinating to watch the answer unfold. Thank you for joining me on The Explainer.